Hi, this is Yeager from No Personal Finance. Here today to talk about something that's excited me recently. So I stumbled on an article about Warren Buffett. Warren Buffett is my favorite investor because, first off, I'm a Midwesterner, and he just definitely has those vibes. He's very down to earth and just seems like a nice guy in general. And also because his approach to investing is very long term. He doesn't believe in day trading, basically. And he also his philosophy that he took on from one of his professors is called value investing. That means that when he looks to invest in a company, he goes through their financial statements and sees, two things. Are they undervalued? Like, is their stock lower than it should be? And secondly, what are their values? Do they put the customer first? Do they deliver a good product? Or are they just out there for money? So those are the criteria that he sets for investing, and obviously he's done a good job. So anyway, back to the article. In it, they talk about Warren Buffett's estate. So basically all his billions that he's accrued and what'll happen with it after he dies. And they said that he's investing it in something called ETF, which is an exchange traded fund. So ETFs are they're similar to mutual funds, which basically means you take like 10 different stocks. So let's say the first one was Apple, second one was Google, etc. And then you combine them together into one fund. Only the 10 stocks, that's typically what a mutual fund is, but exchange traded funds have aspects of that, but they're more focused on stock indices. So again, I'll get into that. So what's a stock index? If you think of the Dow Jones, that's a stock index. Basically, you take some of the top companies in the country and you kind of aggregate them onto one view. So for example, the Dow Jones might be like several older companies that do really well, and they use that to gauge the overall health of the stock market. That's basically what they refer to when you talk about the stock market, is things like the Dow Jones, the S&P 500, and the NASDAQ. So the specific, going back to the ETFs, exchange traded funds or ETFs are a special type of fund that mimics a certain index. So it mimics, for example, the Dow Jones or the S&P 500. So the ETF that Warren Buffett was investing in is it mimics the S&P 500. So he did this because he figured three things. The fund he invested in is a bit volatile. It goes up and down. It can be a little risky, but so with that, that's the bad part of the risk. The good part is there's a large potential for gains. So they say that if you are looking to invest for a long time, if you're young, it's good to invest in riskier funds or stocks. So there is that aspect of risk. There's that aspect, the double-sided part of risk being a lot more potential gains. The second aspect is to kind of temper that risk, though. If you think about the overall stock market, like I said earlier, like the S&P and the Dow is basically what people refer to when they talk about the stock market. If you look at the history of the stock market from the very beginning, on average, it's gone up by 7%. It's just like if you look at a chart of the stock, like let's say the S&P since it was formed, it it's a general rising trend. I mean, you see different peaks and valleys, like, for example, the Great Depression, or the economy really since like 2010, 2013, where it rose up a lot. But overall, the line is pretty steady. It just goes up, and the rate that it goes up is about 7%. So let's say if the stock market was at, let's say, it doesn't really work this way, but if all the stocks were worth $100 this year, 2020, then next year, on average, they'll be worth $107. So that's how it kind of works. So back to what I was talking about. This ETF that Warren Buffett was investing in, it mimics the S&P 500. So it, in general, if you're investing for a long time, it'll go up by 7%. So again, while it is risky in that the stock market fluctuates a lot day to day and even year by year, if you're investing for a long time, it's actually pretty safe. So that's the second of the reasons. The first one, again, was high potential for gains / kind of risky, so high potential for losses. Second is ETFs they mimic the overall stock market, and the stock market, at least if you look at the S&P 500, has risen. It's just on average has gone up ever since it was formed. Another way that ETFs are unique and different from mutual funds, ETFs are not managed by a person. At least not the ETF that Warren Buffett was investing in. So mutual funds typically are managed by an actual person. They will adjust the level of investments. Like, say, if a mutual fund invested in Apple and Google and Facebook, maybe they might buy more stocks of Apple to go into the mutual fund. So, yeah, they call that active management. In comparison, the ETF doesn't really need to be managed by a person because it mimics the stock market. It's just going to change based on the stock market. So if the stock market goes up by 7 points, it'll generally go up by the same kind of, proportion. So anyway, the fact that a person doesn't manage this ETF means that the expenses from the ETF are lower. You're not paying anybody a salary, so you kind of cut that out. And as you know, people in financial services are paid a lot, so you're reducing your expenses by a lot if you go with an ETF. I like this because I personally invest using Vanguard. They're the leading investment platform, leading broker, and they have an ETF called, its ticker symbol is VOO. It's a Vanguard S&P 500 ETF, and I invested my IRA in it. I had previously been invested in what was called a target date retirement fund, which is a mutual fund. So I switched it over to this VOO. And by the way, if you Google VOO, it'll bring up the exact fund. But anyway, I invested in this because there's a specific part of the fund. It's called, in technical terms, it's just called the expense ratio. So the expense ratio accounts for every aspect of, how the fund is managed. So the expense ratio for the target date fund that I had been invested in from Vanguard was 0.15%. So that means that if that fund went up by 7% in 2020, then 0.15% of those gains would be just taken by the fund manager and the company that's managing it, Vanguard. So basically, That might not seem like a large amount, but if you're investing thousands of dollars, it can add up. Anybody's smart enough to know that the less you spend, the better it is, the more money you make. So the target date fund, its expense ratio is 0.15%. And the ETF, by comparison, its expense ratio is 0.03%. So the ETF has 1/5 of the overall expenses that the target date fund has. So that's another way, again, how it's just a better way to invest. So for younger investors, I'll say people who are in their 30s or younger, I would suggest going with an ETF like VOO for your investments, either in your 401k, your IRA, or otherwise. But if you're close to retirement, I wouldn't encourage using an ETF because of the volatility. Basically, like when you're close to retirement, you need to know that the amount of money you have will remain stable, because that's what you're living off. You don't have a salary anymore after you're retired. So that's why I wouldn't recommend going with ETF after you get older, after you're closer to retirement. But if you are in that younger range, then it is a good idea. So that is a long introduction to investing in general, and something that I've just a recent discovery that I've made that's made me really happy in the past week. So if you're interested in learning more about this or other financial advice or resources, go to our website at nopersonalfinance.org. This is Aaron Yeager signing off.